SoFi technology stock is crushing. It's up more than 20% after the company reported earnings. And investors are probably wondering what in the world has exactly got the stock up. Yes, the earnings were good. The company generated positive net income. The growth metrics look good. There's a lot going on that's really positive. I want to talk about the key reason why the stock was actually up and why it matters. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. Motley Fool is going to give you its 10 best stocks to buy right now. Okay, I'm going to bring up the stock chart just to see where we are up to the minute here. Stock's up about 20% now. Even within the trading day, it's been pretty volatile. It was up 23% in the morning, took a little bit of a break in the afternoon, and then started to come back up again, staying right around that 20% gains. Let's take a look at the results. We'll start with the news release and the key numbers here. 35% growth in net revenue, 100% growth in adjusted EBITDA. We have to be careful with that. Anytime you're taking EBITDA, which is an adjusted metric that leaves out important stuff like interest expense, taxes, depreciation, and amortization. You leave that out and then you adjust for other stuff too. You got to be careful. But the point is that number was really good. Reported net income is a couple cents a share, $20 million or so. They delivered strong results. I'm going to pull up the presentation and hit on a couple of key things. Members, we talked about this in other videos. That was up 44%. Keep adding tons and tons of new members. I think they're about 7.5 million now. Products, savings account, or loan, or trading account, or one of the other products that they offer, that number's up 41%. I want to say the growth of products has started to trail members in a little bit. It's okay, but I don't love that. Again, if you look at the number of products versus the number of members, it's close to, call it 1.5 products a member is a good round number. You want to see that number accelerate over time. So that's the reason that I mentioned it. Galileo started to show some good signs of continued growth. You go back to the beginning of last year and we saw growth basically fell in half, but it's been consistently in that low double digits. This is a pretty good number. It's stable. This is an important business. Management says they're in negotiations with some potential really big customers that have large account bases that are existing that they would be bringing to the platform. So there's positive stuff still happening there. I'm going to jump towards the end of the presentation. I want to focus on something, and that's a look at the loan book. This continues to be the most important thing that I think investors need to focus on. And this is, how is their origination profile looking? Origination, this is when you write a loan, you fund the loan, signed on the dotted line, you've given the customer the money, you funded the purchase of the home, whatever it is. They do 3 basic types of loans. Home loans is the smallest, newest part of the business. Personal loans is the big core. And then, of course, student loans. So the foundation the business was originally based on, and we're just now, we've talked about this before. You see, it was in the third quarter of 2023 that business is starting to come back, because the vast majority of the pandemic period, federal student loans were under a payment moratorium. People didn't have to make those student loan payments. They had no reason to refinance them. That's changed. People are having to make their federal student loan payments again, and that means we're starting to see growth in originations there. So big third quarter, not quite as good in the fourth quarter, but a lot of loan activity in general kind of backed off in the fourth quarter. So we saw the same thing with personal loans. It was a smaller result than in the third quarter. Same thing in home loan originations. It slowed down a little bit from the third quarter. Not a big concern though. You look at the year-over-year numbers and really good growth. Student loan originations almost doubled. Personal loan originations went from 2.5 million to almost 4 million. And home loans originations, again, this is still a really small business, but more than tripled. And actually 2023 home loan originations was larger than 2022. They're starting to get some traction there as rates come down, people adjust to higher interest rates. But again, personal loans, student loans, starting to see a ton of growth in student loans. Personal loans continues to deliver. So those are the core things about the business. The results are good. The growth story is intact. Profitability is intact too. I want to talk about the key thing that's driving the stock price up, and we're going to get to it. But part of the reason the stock price went up so much was in the guidance that the company gave. I'm going to go to the press release and highlight really the core of it that I think is part of what has the stock up so much and has investors really excited. Okay, here we are. We're going to focus on guidance and outlook, because the bottom line is we love to look back, but in general, the market is always looking ahead. If we're going to buy a company, we want some idea of what they're going to be doing going forward. And that's where things get really, really interesting and exciting for SoFi. So the first thing the fourth quarter, that little bit of profitability, they're saying that for full year GAAP net income, they're expecting earnings per share 7 to 8 cents a share. That's great. That's continuing profitability, which if you're a bank, you got to do that. So that's an exciting thing. But I think even more important than that is the outlook that the company gave looking into 2024 and beyond. They're continuing to expect revenue to grow 20 to 25% through 2026. That's a slowdown from now, but that's still really good if you're looking at the next 3 years, 2024, 25, and 26. They're continuing to still have really high growth. They're expecting 50% compounded annual growth for the financial services revenue. Now they're saying mid 20% for their technology platform revenue. So they're looking for accelerating growth over there. That's really exciting. And then mid-teens growth for the lending business. That's an incredibly high rate to grow your lending business. This is a big one. This one really jumped out at me. They're expecting 55 to 80 cents in GAAP earnings by 2026. That means that the stock is actually pretty reasonably priced in the low to mid-teens price to earnings for 2026 earnings with the growth rates that they're generating right now. But I don't even think that is the biggest reason that has SoFi stock jumping so much. I'm going to bring up one more chart. We're going to look backwards at some numbers here that will help put this in perspective, why the stock is up so much, why it matters, and why investors should be thinking about it. Here is a chart of SoFi stock price all the way back to the beginning of 2023. There are some pretty steep periods of the stock price going ballistic and then coming back down. And what happens when the stock price shoots up almost always has to do when there's periods of lots of short activity. If there's one thing that SoFi has been really good at, it's continuing to report strong quarters, really good growth, and continuing progress on that track to profitability that they just now reached. Nonetheless, even as the stock price has climbed, the short percentage followed the stock price higher as shorts that don't believe in the business model, don't believe that the company can consistently get to profitability, increase their short position, and then the company reports a good quarter, the stock price skyrockets, and then you see the shorts get squeezed out. We saw it last quarter. We saw it in the third quarter, the second quarter. It's a consistent pattern that we see. But then they start building up those short positions again, pushing the stock price down along the way, because the way that you close a short, this is what drives the stock price up, you have to buy the stock back. You create a short by selling the stock short. You borrow somebody else's stock, you sell it short, and you're selling. The selling action drives the price down. But then closing out those shorts, reducing short exposure, you're buying those shares that you've borrowed back. So what that means is I think a lot of today's buying activity, that bullish buying activity, is just shorts closing short positions out or maybe reducing short exposure. So part of the buying is kind of artificial buying of shares that were borrowed by a short so they could sell those shares. In other words, it's not really longs. It's not really full long-term long investors in the business that are a big part of the reason the stock price has gotten bid up so much on this single day. It's some investors out there that saw an opportunity to short the stock that are now saying, you know what? It's time to move on. If you're a bull, you might be thinking, good, they got burned and they got hurt. But I'm going to share one more chart to show you that, you know what? Sometimes these shorts, even on a day like today, they probably still did okay. Let me show you why. Guess what? Even after this huge move up, stock is still down 8% for the year. Let's do this. Let's just go back over the past 6 months. Off of the high over that 6 months, the stock is down 20% still. If you look over the past 3 months, still down 11%. Again, year to date, still down 8%. Obviously, that's not as good as it was yesterday if you were a short. But the point is that shorts have still been able to make money. What does it really mean? I think the most important thing investors need to remember is that it means this is going to be a volatile stock. I'm not sure what the short percentage is going to look like when we see the next data on short float, but I'm pretty sure it's going to have come down after these results and after the guidance that management laid out going all the way out to 2026. But I can promise you, as soon as there's any cracks, any visibility that tells investors that are potentially going to be short this stock, that there's an opportunity, maybe just on the price action, there's an opportunity to make money and build out their short positions, that's going to create volatility. And you have to remember that. Company is barely profitable now. It's gotten there. They're expecting to remain barely profitable for the rest of the year and then start eking into more and more profitability as revenue continues to grow, as their loan book grows, as their net interest margin continues to expand. Put all that together, what's an investor to do? Number one, you own shares and you intend to continue owning shares, buckle up. It's going to be a bumpy ride. Number two, remember, as good as the results have been, SoFi still has a pretty significant amount of exposure to macroeconomic concerns. Their loan book is so much made up of those personal loans. Those are unsecured loans. They get great yield on them. You're talking about 12% interest rate. I think somewhere in that area is where their average interest rate is. It's one of the reasons that their net interest margin is somewhere around 6%. It's like double what a lot of big banks get. The reason is because they're willing to take on these riskier loans, even though their average borrower has a very high FICO score, has a very high earning, has good debt to income ratios. These are the kind of loans that when people have to start tightening their belt, it's the first things that they're going to start paying late or even stop paying altogether. You have to remember that is part of the risk of owning SoFi. It's not like other banks. That's great, but it's also not like other banks, and that creates risk.